Welcome to our latest video on how to understand and use financial statements. As a well-respected economist, I will be providing you with key insights and tips on how to effectively read and analyze financial statements, which will help you make informed financial decisions. First, let's define what financial statements are. Financial statements are formal records of a company's financial activity. They provide information on a company's financial performance, including income, expenses, assets, liabilities, and equity. The three main financial statements are the balance sheet, the income statement, and the cash flow statement. The balance sheet shows a company's assets, liabilities, and equity at a specific point in time. The income statement shows a company's revenues and expenses over a period of time, usually a year. The cash flow statement shows the inflow and outflow of cash and cash equivalents over a period of time. When analyzing financial statements, it's important to consider both the past and current financial performance of a company. This will help you identify trends and patterns in the company's financial performance, which can indicate potential opportunities or risks. It's also important to compare a company's financial statements to industry averages and benchmarks. This will help you understand how the company is performing relative to its peers and competitors. Additionally, it's important to consider the company's management and ownership structure when analyzing financial statements. The management team's ability to effectively manage and allocate resources can have a significant impact on a company's financial performance. Another key aspect to consider when analyzing financial statements is the use of financial ratios. Financial ratios are mathematical calculations that provide insights into a company's liquidity, solvency, profitability, and efficiency. Some examples of commonly used financial ratios include the current ratio, debt-to-equity ratio, and return on equity, ROE. It is very important to understand the difference between cash flow and net income. Cash flow is the amount of money coming in and going out of a company, while net income is the profit or loss after all expenses have been taken into account. Understanding the difference between these two terms can help you make better investment decisions. It is also important to understand the concept of liquidity. A company's liquidity refers to its ability to meet its financial obligations as they come due. This can be determined by looking at a company's current ratio, which compares its current assets to its current liabilities. A company with a high current ratio is considered to be more liquid than one with a low current ratio. The balance sheet is another important financial statement that provides information about a company's assets, liabilities, and equity. The balance sheet shows a snapshot of a company's financial position at a specific point in time. It is important to understand how to read and interpret a balance sheet in order to make informed investment decisions. The income statement, also known as the profit and loss statement, provides information about a company's revenue, expenses, and net income. It is important to understand how to read and interpret an income statement in order to evaluate a company's performance over a specific period of time. The statement of cash flows provides information about a company's cash flow from operating, investing, and financing activities. It is important to understand how to read and interpret a statement of cash flows in order to evaluate a company's ability to generate cash flow and meet its financial obligations. The statement of retained earnings shows the changes in a company's retained earnings over a specific period of time. Retained earnings are the portion of a company's net income that is kept by the company rather than being distributed as dividends to shareholders. Understanding the statement of retained earnings can help you understand a company's financial health and its ability to reinvest in itself. It is important to understand the concept of a company's return on equity, ROE, and return on assets, ROA. ROE measures a company's profitability in relation to its shareholders' equity, while ROA measures a company's profitability in relation to its total assets. A company with a high ROE or ROA is considered to be more profitable than one with a low ROE or ROA. By understanding and utilizing financial statements, you can gain a deeper understanding of a company's financial health and make more informed investment decisions. In the next section of this video, we will be going through the process of how to read and analyze financial statements in more detail, including looking at specific examples. Thank you for joining us, and stay tuned for the next part of our video on how to understand and use financial statements. Please, like, share, comment and subscribe.